Hey guys, welcome back to the channel. If you've ever wanted to invest in real estate but thought you needed hundreds of thousands of dollars for a down payment, here's the truth. You can actually start with a little as $100, sometimes even less, by investing in something called REITs. And in this video, I'm going to walk you through exactly what REITs are, how they work, the benefits, the risk, and even how to analyze them so you can make smart, informed investment decisions. By the end, you will know whether REITs deserve a spot in your portfolio. So what exactly is a REIT? REITs stand for Real Estate Investment Trust. In simple terms, it's a company that owns, operates, or finances income producing real estate. That could be office buildings, shopping malls, apartment complexes, warehouses, data centers, even cell towers. The key is that REITs allows you to invest in large scale income producing real estate without having to actually buy the property yourself. Think of it as pooling your money with thousands of other investors to own a slice of massive real estate projects that you could never afford on your own. Here's how it works. You buy shares of a REIT just like you'd buy shares of Apple or Microsoft. The REIT collects rents from its properties, pays expenses, and then passes the majority of its profits back to you in the form of dividends. In fact, by law, REITs must pay out at least 90% of their taxable income to shareholders every year. That's why they tend to have higher dividend yields than most regular stocks. Now, why would anyone consider adding REITs to their investment portfolio? Let's go through the benefits first. Number one, accessibility. Traditional real estate requires large amounts of capital, financing, and a lot of work to manage. With REITs, you can start investing with as little as the price of one share. No need to find tenants, deal with repairs, or worry about property taxes. Number two, diversification. Real estate tends to move differently than stocks and bonds. Adding REITs to your portfolio can lower your overall volatility because they are influenced by different market factors. For example, when tech stocks are having rough time, real estate income might still be steady. Number three, passive income. REITs are income focused investments, meaning they are designed to pay you regularly, often quarterly, or even monthly. This can make them appealing for retirees or anyone looking to supplement their income. Number four, liquidity. Unlike physical real estate, which can take months to sell, publicly traded REITs can be bought and sold instantly through your brokerage account. You can adjust your holdings whenever you want, which is a huge advantage. But of course, no investment is perfect, and REITs comes with their own risks. One risk is market volatility. While REITs represent real estate, their share prices can still swing like regular stocks because they are traded on exchanges. You are not insulated from the ups and downs of the market. Another risk is interest rate sensitivity. REITs often borrow money to acquire property, so when interest rates rise, their borrowing costs increase, which can squeeze profits. Higher rates also make their dividend yields less attractive compared to safer options like bonds or CDs. Third, not all REITs are created equal. Some focus on high quality, well-located properties with long-term tenants. Others may chase riskier, low-quality assets to boost returns. Choosing the wrong REITs can mean poor performance and even dividend cuts. Fourth, taxes. Because REIT dividends are taxed as ordinary income, you might pay a higher tax rate on them compared to qualified dividends from other stocks, depending on your situation. This is why many investors prefer to hold REITs in tax advantage accounts like IRAs. Now let's talk about the different types of REITs, because not all of them operate the same way. The most common are equity REITs. These own and manage properties and make money mainly through rent. Then there are mortgage REITs or MREITs, which invest in mortgages and mortgage-backed securities rather than physical property. They can have high yields but also high risk, especially when interest rates fluctuate. Lastly, you have hybrid REITs, which do a mix of both. You can also break them down by property type. Retail REITs own shopping centers, residential REITs own apartments, industrial REITs own warehouses, data center REIT stores and manage digital infrastructure, and so on. Each sector comes with its own pros and cons depending on the economy. So how do you actually analyze a REIT to decide if it's worth investing in? There are a few key metrics to know. First, funds from operations, or FFO. This is the REIT's equivalent of earnings per share for regular companies. It tells you how much cash the REIT actually generates after accounting for property depreciation, which can distort profits on paper. Generally, you want to see consistent or growing FFO. Second, the dividend yield. This is the annual dividend divided by the share price. Higher isn't always better. A yield that's way above industry averages might be unsustainable. Look for a payout ratio based on FFO that's reasonable, ideally below 80 to 90%. Third, debt levels. REITs need to borrow to grow, but too much debt can be dangerous if interest rates rise or rental income drops. Check their debt to equity ratio and interest coverage ratio to make sure they are financially healthy. Fourth, occupancy rates. This tells you what percentage of the properties are rented out. Higher occupancy means steadier income. And finally, management quality. Look at the REIT's track record, leadership team, and history of dividend payments. A REIT that has paid and grown its dividend for many years through different economic cycles is often a good sign. To give you a concrete example, let's look at a few well-known REITs. Realty Income, ticker symbol O, is known as the monthly dividend company because it pays dividends every single month and has increased them for decades. Prologis, ticker PLD, is an industrial REIT focused on warehouses and logistics, benefiting from e-commerce growth. Digital Realty, ticker DLR, is a data center REIT, riding the wave of cloud computing and AI expansion. Each of these has different strengths and risks, and analyzing them with the metric we discussed can help you decide if they fit your goals. If you want to start investing in REITs, you have two main paths. You can buy individual REIT stocks, which gives you more control but requires more research. Or you can invest in REIT ETFs, which hold dozens of REITs and gives you instant diversification. Examples include the Vanguard Real Estate ETF, ticker VNQ, and the Schwab US REIT ETF, ticker SCHH. These are great for beginners who wants exposure without having to analyze each REIT individually. One smart approach is to start small, maybe dedicate 5 to 10% of your portfolio to REITs and see how they perform over time. Remember to keep them in balance with your other investments so you're not overexposed to real estate. And a quick note, just because REITs can provide high income doesn't mean you should chase yield blindly. Always consider the sustainability of the dividend, the financial health of the REITs, and the long-term trends in the property sectors they operate in. At the end of the day, REITs can be a fantastic tool for building passive income and diversifying your portfolio, especially if you don't have the time or money to buy and manage real estate yourself. They are not risk-free, but for many investors, they strike a great balance between accessibility, liquidity, and income potential. If you've been sitting on the sidelines because you thought real estate investing was only for the wealthy, REITs might be your ticket in. Do your homework, start with quality names or diversify ETFs, and build from there. With that being said, if you found this video helpful, make sure to like the video and subscribe, and I will see you in the next one.